Hello everyone, welcome to the 137th episode of me learning how to trade in Forex. So in the last episode we went through what is leverage. Basically, a leverage enables you to control a large amount of financial asset using only a small amount of your trading capital. So when you buy an asset in a traditional way, you generally have to pay the full purchase price up front, the total value of shares, currency, barrels of oil, or whatever you're trading. However, some providers offer the facility to trade using leverage, which means you only have to put up a fraction of the value of your position. So that means any profit you make, which is still based on the full value of the position, appears magnified in comparison to your outlay. On the other side, this means that any losses are also magnified as well. So we'll learn about how leverage works, magnified profits and losses. So it's vital to prepare yourself for situations like this by always keeping in mind the full value of your trade and the potential for loss when you're using leverage. Okay, and then we went through this question and the cost of using leverage. So since you don't put up the full value of your position with trade with leverage, this means your trading provider is effectively lending you the balance of the money. For this reason, they may take a small charge to reflect their costs when you keep a trade open overnight. This is called an overnight funding charge, so remember that. And then we went through the lesson summary. So now we're on to margin calls. Date 16th. Right, let's get started with margin calls then. As we've discussed, to open a leverage trade, you need only deposit a fraction of its value, but your losses can exceed this amount. This means that if a position moves against you, or your provider may ask you to provide additional funds to keep your trade running. These payments are known as variation margin, although people usually just refer to them as margin. A request for variation margin is called a margin call. Margin call is the request for additional margin when your loss exceeds your deposit amount. Your position deposit amount. Example, say you buy 8,000 shares at 220 pence using leverage. The value of your position is therefore 17,600. The provider asks for initial margin payment of 5%, which is £880. The share price then drops by 1p to 219 pence, reducing the value of your position to £17,520. The margin requirement falls to 5% times 17,250, which is equal to £876 of result. However, although the initial margin requirement has reduced, you now have a running loss of 1p times 8,000, which is 80 pence. To add to this, bringing the total required to keep your position open to £956. Unless you're already holding sufficient funds in your account to cover this, your provider will ask you to make a margin payment. If you don't do so promptly, they may scale back or even close your position completely. Buy 8,000 shares at 220p using leverage. Value of position is therefore 70,600. You only pay £880 to keep the 17,600 position open. Right? Share price drops by 1p to 219, reducing the value of your position to 17,520. Yep, because that's 219 times 8,000, so that's 17,520. The margin requirement falls to, so it's 5% of that, £876 as a result. Yep. However, although the initial margin requirement is reduced, you now have a running loss of 1 pence times 8,000, which is £80 to add to this, bringing the total required to keep your position open to £956. Right, I see. So it's 876 plus 80. Right, okay. Dividend payments on short positions and funding costs are also factors that may sometimes put your account into deficit, requiring you to deposit more money. So it's wise to remember that the initial cost of opening a position isn't the end of the story. You may need to have more funds available to top up your account as you go. It's wise to remember that the initial cost of opening a position isn't the end. You may need to have more funds available to top up your account as you go. Deciding whether to use leverage. We've seen that trading with leverage gives you comparatively greater profits, but also relatively larger losses. So does it make it riskier than conventional trading? From one perspective, yes. If you commit yourself to a leverage trade based on the affordability of the initial margin, rather than your capacity to withstand potential loss, you're undoubtedly playing with fire. However, as long as you think of every position in terms of its full value and downside potential, the risk is no greater than it would be when trading directly. Your eventual profit or loss is the same. It's only the outlay to produce it that differs. There are also a number of steps you can take to manage the risks of trading. We explain these in the planning and risk management course. So provided you understand how leverage trading works, it can be a very useful tool. There's no need to tie up a large amount of your trading capital on one trade, and you can deal on expensive assets at a fraction of the cost. Used sensibly, leverage can make trading easier and more convenient. But still risky though, isn't it, for a beginner trader to use leverage trading, as we've seen from the School Pipsology course before. So yeah, ways to trade with leverage. A wide range of leverage trading products are available, covering almost every conceivable market, and many providers offer at least some degree of leverage on trades. Most leverage trading is done through derivative products. So most leverage trading is done through derivative products. Financial instruments that derive their value from underlying assets. Financial instruments that derive their value from an underlying asset. With a derivative contract, you never own the underlying asset directly, but you have the financial interest in its performance. With a derivative contract, you never own the underlying asset directly, but you have the financial interest. But you have a financial interest in its performance. Here are the main ways you can choose to trade with leverage. Spread betting, UK only. Financial spread betting providers enable you to place a bet on the direction a market will take, rather than trading the market directly. Contract for differences. A CFD is agreement to exchange the difference in value of a particular asset from the time at which a position is opened to the time at which it is closed. Forex trading. You can speculate on the future value of one currency compared to another via a Forex broker. Futures. A futures contract is agreement to buy or sell an asset at the same time, at some time in the future, for a particular specified price. Options. Options are contracts that give you the rights but not the obligation to buy or sell an underlying asset at a fixed price on or before a certain date. Main ways you can trade with leverage. Spread betting, UK only. Financial spread betting providers enable you to place a bet on the direction the market will take rather than trading the market directly. So you place a bet on the direction a trade will take, direction a market will take, rather than trading the market directly. Contract for differences. An agreement to exchange the difference in value of a particular asset. Agreement to exchange the difference in value of a particular asset from the time at which the position is opened to the time at which it is closed. Forex trading. Speculate on the future value of one currency compared to another via a Forex broker. Speculating on the future value of one currency compared to another. Futures. A futures contract is an agreement to buy or sell an asset sometime in the future for a particular specified price. Futures contract is an agreement to buy or sell an asset in the future for a specified price. Isn't that sometime like specified as well? So on that exact day for that exact price, right? Okay, for particular options. Options are contracts that give you the right but not the obligation. Contracts which give you the right but not the obligation to buy or sell an underlying asset at a fixed price on or before a certain date. Cool. Lesson summary. If a leverage position moves against you, you may get a margin call from your provider asking you to top up your account. Leverage trading can be regarded as riskier than traditional trading, although profit and losses are the same in both cases and only the initial outlay differs. Leverage trading is mainly carried out using derivative products. Good. Okay, little quiz. Yep. Okay, what is the correct term for an order that has been executed? A failed order. You buy shares in ABC plc, currently trading at 500 pence. Although the price is forecast to rise over the next few weeks, you expect it to fall shortly afterwards. You set a limit order to close the trade if it reaches 525 pence. Although ABC plc share rises to 550 pence before plummeting to 400 pence. What happens to your trades? Your limit order triggers 525 pence. When trading derivative contract, you never need to own the underlying assets. You purchase 100 shares of XYZ PLC Inc. for $50 each. You think the price could skyrocket, but are also wary it could fall considerably. You decide to attach a guarantee stop to the trade at $40 just in case. A few weeks later, the share price of XYZ Inc. stands at $30. Ignoring any commissions or fees or ignoring any commission fees or charges, how much loss would you sustained in dollars? 100 shares for 50, so that's 50 times 100. 50 times 100. I'm pretty sure I don't need a calculator for this, but just to make sure, should be 5,000, right? Yeah, 5,000. Guarantee stop at 40. So 50 minus 40 times 1,000. Times 1,000. You lost $1,000. What is the term used when a trade executes at a worse price than your stop order is specified? Slippage. Food Conglomerate PLC is currently priced at 1,000p per share. You decide to open a leverage position and buy 400 shares. Your provider's margin requirement for Food Conglomerate PLC is 5%. What is your maximum possible loss on this position? Assuming you don't use a stop loss, then how much margin must you pay? So maximum loss is when the shares drop to 0, so 1,000 times by 400. So you could lose, divided by 100, you could lose £4,000. Maximum loss is £4,000. Okay, so it's either A or C. So 4,000, that's £4,000. Yeah, right, 400 times 1,000 divided by 100. Margin requirement is 5%, times by 0.05. £200. Margin is £200. Maximum loss 4,000. Margin £200. Which type of order is being described below? If this order can't be filled in full immediately, it will be cancelled. If this order can't be filled in full immediately, fill or kill. Say you want to buy 5,000 shares in Sports Giant Inc. and each share is priced at $2. You find a provider offering leverage facilities and C is charging a margin deposit 5%. How much margin would you need to put down to open your position in dollars? So 5,000 times by 2 equals that 10,000 times by 0.05, $500. Which type of order is being described below? This order is an instruction to trade when the market's price reaches a level that's more favorable than the current price. This order is an instruction to trade when the market that's more favorable. A limit order. You want to go long on Tech Corp Inc. and the current share price is $1. You find a provider offering leverage facilities which sets the margin requirement at 5% to open the position. You put down $250 to open their trade. How many shares do you have exposure to? $5 to open the position. You put down $250 to open. So that $250 is basically 5%. So 250 is 5%. Times by 1.95, right? No, wait. No, wait. Current share price is $1. How many shares do you have exposure to? So 5%, $250 is 5%. That means 100%. $250 is 5%. That means a full position is $250. 100 divided by 5, 20. 250 times by 20, 5,000. Yeah, 5,000. Nice. Look at that. Yeah. What is the correct term for an order that's been executed? A filled order is an order that's been executed. You buy shares in ABC PLC trading at 500 pence. So your limit order is triggered and your trade is closed at 525 pence. This means you didn't fully profit from the price peaking at 550 pence, but neither did you lose anything when it fell to 400 pence. Yep, which is good. With a derivative contract, you never own the underlying asset directly, but you have the financial interest in its performance. So you place a guarantee stop at $40, which is $10 below the purchase price. So in this scenario, you would have suffered a $1,000 loss because $10 times 100 shares. Without your stop order, you could have lost 2,000 or more. Slippage often occurs during periods of high volatility when market orders are used, or when large orders are executed and there is enough interest at the desired price level to maintain the price of a trade. If the stock falls to zero, your loss is equivalent to the full value of the shares. 1,000 pence times 400 shares is £4,000. Your margin payment is 5% of the full value of the shares, so £4,000 times by 0.05, which is £200. A fill or kill order designates that a trade must be executed immediately and completely, or not at all. So the full value of the position is $10,000 because it's 5,000 shares times by $2. You margin deposit 5% of this, so 10,000 times 0.05, which is $500. A limit order can be used to open a new trade, but you can also use it to close an existing position, taking profit when the market hits your target level. So when trading on leverage, you only have to put up a small fraction of the total value of the position to open your trade. In this scenario, it was 5% of 5,250. However, you still have exposure to the full size of the position. In this case, 5,000 shares. Cool. So which one was that? That was it this one? What is an order? Okay, so that's orders, execution, and leverage done. What is an order? So now we're on to planning and risk management. Ask any successful trader for their top tips, and you can be sure one of them will be to stick to a clear trading strategy. Here we explain the tools and techniques you can use to guide your trading decisions, showing you how to create a plan that's tailor-made for you and your personal goals. We'll also introduce you to some crucial ways to manage risk so you can safeguard your profits and minimize your losses. Lastly, we look in detail at the 4 main types of trading style, helping you decide which is likely to work best for you. Nice. So, what is a trading plan? Bing, bong. Right. So, what is a trading plan? Having a suitable trading plan is one of the most important aspects of trading. It's there to act as your own personal decision-making tool, helping you answer vital questions like what, when, why, and how much to trade. Your plan should cover your personality, attitude to risk, trading goals, risk management rules, and any trading strategies you tend to follow. So, having a suitable trading plan is one of the most important aspects of trading. It acts as your own personal decision-making tool. Helping you answer questions like what, when, why, and how much to trade. Your plan should cover your personality, attitude to risk, trading goals, risk management rules, and any trading strategies you intend to follow. It is vital for your trading plan to be personal to you. It's no good copying someone else's plan, because that person will very likely have different goals, attitudes and ideas to you. They will also almost certainly have a different amount of time and money to dedicate to trading. Your trading plan must be personal to you. What's the difference between a trading strategy, a trading plan and a trading diary? You'll hear these terms used a lot in the industry, often interchangeably, but for the purpose of this course, we'll be talking about specific things when we refer to them. So, trading strategy defines precisely how much you should enter and exit trades. How much precisely how much you should enter and exit trades. How you should enter, not how much you should. Okay, God, I can't read. How you should enter and exit trades. For example, buy gold when it drops below $1,250. Sell when it reaches $1,350 would be a very simple trading strategy. Trading plan. A comprehensive blueprint covering anything from your goals, motivation and attitude to risk. Comprehensive blueprint covering everything from your goals, motivation and attitude to risk, through to risk management rules and analysis of past trades. Goals, motivation, attitude to risk, risk management rules, and analysis of past trades. It can and should include both your strategies and your commitment to keeping a diary. It can and should include both your strategies and your commitment of keeping a diary. It should include both your strategies and your commitment to keeping a trading diary. Trading diary is a written record of everything that happens when you trade. A written record of everything that happens when you trade, including entry and exit points, includes entry, exit points, profit loss, trading statistics, and even your emotional state before, during, and after each trade. And your emotional state before, during, and after each trade. Hey. Ooh, we've got a cheeky little video.
A risk management plan, often the difference between success and failure. You can have the best trading platform in the world, but without proper risk management, you could still fail. So here are 5 steps to help you trade with confidence. Step 1, know all the potential risks. These are just some of them. Take currency risk, for example. A company in Australia that depends on imports will profit from a strong Australian dollar. One linked to exports will suffer. Or commodity risk. If the price of aluminium goes up, companies that use the metal in its production, like Alcoa, will see costs go up. Step 2. Define your own risk limits, the maximum amount you can afford to lose on any single trade and across your whole portfolio. Before asking, what profit can I make? First ask, what potential loss could I suffer? And set stop losses accordingly. Which leads me neatly to step 3. Know when to take a loss. Once you've set a stop, stick to it. Never move it further away thinking the market will turn. That's when big losses can occur. And that plays into step 4. Be aware of emotional trading, the enemy of success. Fear and greed can often destroy a trader. One study suggests emotional trading, which can tempt you to buy high and sell low, can cost you nearly 20% of returns over a 10-year period. So stick to your risk limits and learn from your losses as well as your gains. Finally, step 5. Ignore those around you. Each trader has their own tolerance for risk. So while a stop loss, say 30 points below the buy price, may work for Mr. X, it could mean a bigger loss than you can afford to take. Remember, these are just 5 tips to help you control your risk. Proper risk management is a combination of rules and ideas brought together to create your own personal trading plan. So the best way to manage risk is to make that plan and stick to it.
Nice. Okay, so why is a trading plan important? It makes trading easier. A trading plan gives you guidance on when and how you should trade. Without a proper plan, you might be constantly worrying about which market to trade, whether to take your profits early, let your losses run, or if you're missing out on other trading opportunities in different markets. With a trading plan, you've done all the thinking up front, so you can wait for the right market conditions and trade according to the parameters you set for yourself. So, why is a reasons why a trading plan is important. So, makes trading easier. Makes trading easier. Gives you guidance on when and how you should trade. So, gives you guidance on when and how you should trade. Without a plan, you might be constantly worrying about which market to trade, whether to take your profits early, let your losses run, or you're missing out on other opportunities in different markets. With a trading plan, you've done all the thinking up front, so you can wait for the right market conditions and trade accordingly to the parameters you've set for yourself. E.g., which market to trade, whether to take profits early, whether to let your losses run, I know when to take profits, when to take profits, when to set your stop loss. That's that. Trading plan, done all thinking you up front. Trading plan does all the thinking up front, so you can wait for the right market conditions and trade according to the parameters you've set for yourself. It helps you trade without emotion. Trade without emotion. A plan can remove emotional decision making in the heat of the moment. You should already know your desired profit and acceptable loss on every trade before you place it. This means you'll be able to cope with any dramatic changes in the market price as your trade is in progress. Realistically, markets can only go up or down, so you should be able to plan for every eventuality beforehand. Removes emotional decision making in the heat of moment. You should already know your desired profit and acceptable loss on every trade before you place it. This means you'll be able to cope with any dramatic changes in the market price as your trade is in progress. Yep. Helps you maintain discipline. Helps you to maintain discipline. Maintain discipline. Actually, meaning you'll be able to cope with any dramatic changes in the market price as your trade is in progress. Discipline is an extremely important trait for a trader. Anyone can get lucky on a few trades, but a disciplined trader is much more likely to be profitable in the long run. And if you have a solid trading plan, discipline is much easier to maintain. A trading plan helps to maintain discipline. Say you start using a simple trading strategy. For example, you go long on the S&P 500 every time it goes up by more than 0.5% in one day, with the expectation it will continue to rise. However, after a couple of trades, your strategy doesn't seem to be working very well and you've lost some money. Do you abandon it immediately? Depending on your circumstances, you might decide to stick with it. You can then find out if there's a fundamental flaw with this strategy or if you're just unlucky with the first few trades. If it's the former, is there a way you can tweak the strategy based on the result of your trades? By maintaining discipline and sticking to your plan, you could potentially turn a losing strategy into a winning one, or at least discover how and why it wasn't successful. By maintaining discipline and sticking with your trading plan, you could determine if your strategy is fundamentally flawed or you were just unlucky in the first few trades. But with this though, like, how do you know how many trades it would take for it to be like not based on luck anymore and it's just a fundamentally flawed plan? Like, would you need to lose like, I don't know, 10 times in a row for you to say, oh, you know what, this is not about like whether it's lucky or unlucky anymore, my plan is fundamentally flawed, so I need to change it? Like, what's the precise number that you have to like wait for until you know that your plan is not just being unlucky and it's just actually bad? So yeah. Or you were just lucky in the first few trades. If it's fundamentally flawed, you can discover why and how it wasn't successful. Enables you to improve. Enables improvement. By following a trading plan and maintaining a trading diary, you can keep a record of what works for you and what doesn't. This is useful for analyzing your own performance and improving as a trader. By following a trading plan and maintaining a trading diary, you can keep a record of what works for you and what doesn't. So this is useful for analyzing your own performance and improving as a trader. A full record of every trade makes it much easier to learn from your mistakes and to evaluate which trades you won or lost by luck or by judgment. A full set of trading record enables you to learn from your mistakes and see which trades are won/lost by luck or by judgment. Lesson summary. A trading plan is your own personal decision-making tool, helping you answer questions like what, when, why, and how much to trade. It should provide a blueprint of how to trade in any given situation, which makes trading easier, helps you to trade without emotion, helps you to maintain discipline, and enables you to improve. So a full set of trading record enables you to learn from your mistakes and see which trades are won/lost by luck or by judgment. And let's evaluate. Cool. I am going to leave this episode here then. So in the next video we're going to carry on with the planning and risk management course with how to make a trading plan. So thank you all for watching. Bye bye.